Yes, hello everyone. Welcome to the next video. So in this one, we're going to be looking at the next asset class correlations, which is commodities and currencies. So what markets are affected by commodities? Generally, commodity-rich countries that export a lot have a large amount of confluence with certain commodity pairs. Now, this can give us an insight into the fundamentals of a currency's endogenous factors. So what that means is the domestic sort of workings and what's going on inside the economy. The main countries that we look at in terms of comparing commodities and certain economies is, first of all, Australia, New Zealand, Canada, Japan, and the United States. And the main commodities that we look at is crude oil, Brent oil is just a different version of the oil. It's the one from the UK. Then you've got gold and silver, natural gas, and then iron ore. Now, iron ore is particularly prominent with the Australian market and with a few others that we're going to be looking at. So the main exporters, when you have a look at some of the main exporters in the world, and especially when you can actually trade them pairs, these are the ones we look at. So South Africa, which is ZAR on the currency pair, they do a lot of gold, diamonds, platinum, and a few others, but particularly gold. When it comes to Canada, we look at their oil in particular. When it comes to Australia, you look at iron ore and gold. New Zealand is the dairy products, which is the dairy New Zealand Dairy National Index or something like that that we look at. For Russia, it's natural gas and their oil products. Saudi Arabia, of course, it's all about the oil. And then United States, they do quite a lot of goods, but especially when it comes to technological goods. But of course, they import quite a lot as well. So I would say it's more these markets right here that we look at. And of course, you've got to understand the main ones from each sort of exporter. So in terms of gold, this is one of the most heavily traded commodities in the world. It moves very, very quickly. As we know, you know, you can get a 200 pip move in possibly 10 minutes, whereas you might not get a 200 pip move in a whole week on Euro USD, for example. So therefore, it's very volatile, and you've got to be, quite experienced to understand how gold moves and actually understand its price patterns and everything like that. So gold is an essential commodity that you must be aware of in fundamentals. It's mainly its use, of course, you've got gold and jewelry and everything like that, but its main use is as a source of investment and as a hedge against inflation. So as we understand, when there's high inflation around the world, you're going to see certain types of investments that happen, and one of them in particular is gold. So what you're going to see is these types of correlations. As gold, in this example, you get XAU and USD. As you get that on the downturn, you start to see DXY buying up. Then, if you compare gold and also AUD USD, usually you'd start to see some kind of similarities in terms of that bias. Of course, you're not going to get the same exact movements. However, they are going to be quite similar in their directional bias. Now, don't take this as gospel. You need to there's not a direct correlation every single time as you may expect. However, we just use it as an extra confirmation. So if, for example, we saw gold enter a higher time frame point of interest and AUD USD enter a higher time frame point of interest, and they're both correlated, then we can expect some kind of movement in the same direction. Same thing for DXY as well. Now, the main correlation between XAU USD and DXY is the understanding of investment and where people put their money. Are they put it in? Is it a risk on or risk off environment? And what does that entail? Obviously, look back to our first lesson where we looked at risk on and risk off. Now for oil. So gold obviously provides diversification in the portfolio and is correlated with the stock market during risk on periods, while it decouples and becomes inversely correlated during periods of stress. That point right there was meant to be in the last last presentation right there, as you can obviously realize. However, now we're looking at oil. So you've got two different types. You've got US oil, which is WTI US oil, and then UK oil, Brent UK oil. Just different types of oil. I believe Brent oil is a bit, they call it sweeter than the US oil or the WTI that we start to see. The main correlations with that is, of course, you've got to look at the economies that export a lot of oil. So in this case, we're going to be looking at CAD especially. Of course, you've got the other ones such as Saudi Arabia and Russia. But personally, I don't trade these currency pairs. I mainly look at USD CAD and start to look at that. So as again, you're not going to see on a lower time frame maybe that kind of confirmation, but on the higher time frames and understanding that the directional bias of both of them, you're going to understand what impact US oil has on CXY, for example. And then that could lead into any trades that you need to understand for USD CAD. When it comes to understanding US oil, you need to look at the fundamentals of oil. So you need to look at OPEC. So pretty much they're like the Fed of oil. They look at supply and demand of it. So of course, when they increase supply, for example, you can expect that the price of oil will drop, because as supply increases, um, obviously you need to look at supply and demand factors. Usually start to see a drop in price, for example, and obviously vice versa. So that's one thing that mainly drives the US oil market. Then that also leads into the direction of the CXY, because it's such a large export of their economy. USD CAD, of course, has an inverse correlation with these. So if you can understand the fundamentals of oil and understand the fundamentals of DXY, for example, you're going to have a clear understanding of USD CAD. And this is USD CAD is one of people's most favorite pairs because of this reason. Now, whether they look at fundamentals or not, in the technical strategy, it moves quite a lot. You know, although the economies may be quite similar in their monetary policies and everything, this is the differentiating factor. You can actually understand how it's moving and why it's moving. So if you're trying to look for any more commodity pairs or futures contracts, we call it, because this is how traders actually trade the commodity by itself. A lot of them would trade futures contracts. It's slightly different from what we trade in Forex. But yeah, if you're wanting to search them up, what you do is you go on this website called barchart.com. Then at the top of it, you've got the commodity pull down bar. So you click that right there. Then when you click that, you click the commodity that you want to look at. So it's going to have a range. It might have gold, oil, silver, platinum, everything like that. You click on that, then you get the relevant contract, month and year. So the way futures contracts work is they have expiration dates. So if we're in September of 2021, for example, you would look at the September contract. I believe these renew every few months or every month. It just depends on the type of commodity that you're looking at. Then once you click on that, on the relevant one that you want to be looking for, obviously link that up to the time that you're in right now, because the futures contracts, the relevant ones are going to be the ones that are traded at the time. Then you open up the chart in full size. So you're going to get all this information at the bottom right there. Once you have the chart, you open it up fully, and then that's when you can go on the different time frames and do your analysis on there. As we've explored previously, or as I'm going to explore, you start to look at open interest as well. You can look at COT data for this as well. They're the type of indicators that you've gotten there. So that's a good thing about barchart.com. Not only can you use it for commodity pairs, but you can also look at it for FX pairs and understand the open interest lines and everything like that. Before we move on to the last lesson, I'd like to also explore a bit about the iron ore currencies and no, iron ore exports and how that impacts currencies. So it's one of the main exports of Australia. So it's iron ore and gold. Now, I haven't looked at a chart for it because you're not going to see an exact correlation. As I said, for example, with gold and DXY, you're not going to see an exact correlation there. Same thing with iron ore as well. However, it's something that you must incorporate into your fundamental plan. So if you're looking at the fundamentals of Australia, this is one of the main things that you're going to be looking at as well. And that can be explored through here if you're looking for a chart as well. So what can I use barchart.com for? Pretty much everything that we've just explored. Personally, I'm only looking for certain commodities that are relevant to the economies. So for example, New Zealand, if they're increasing exports through dairy, you'd look for the dairy chart on here. In general, you should stick to the main correlations that we've learned in the past 2 videos and be prepared when understanding different asset class correlations. Now, my takeaway message, the whole reason we look at other asset classes is to simply improve our understanding of the general economy and how this impacts our currency pairs. So it's more about the movement of investment, the movement of money, but in particular as well, when it comes to commodities, understanding supply and demand. Seasonality also comes into play over here as well. So there might be certain types of the year where oil and petrol and all these kind of commodities, they might not be in high demand. Therefore, what are you going to expect for price? Now, everything is related in the markets, especially when it comes to different asset classes. So always understand the fundamentals and keep them on point. Understand what their relation is. So obviously moving back, looking at the stock markets, the bond markets, and then the main correlation that we'd always look at is the impact on US dollar and then how that impacts other pairs, for example. So yeah, guys, I hope this was very informative. Obviously take notes, but be aware of the main correlations. So yeah, guys, take care and I'll see you in the next video.